Hello, my dear future chartered accountants. This is Chinmaya Hegde, your learning partner for CA Final, FR and AFM. This is a super duper problem on consolidation. RTP November 23 CA Final FR paper. The reason why I chose to solve this problem because this has Ind AS 110 consolidation, of course. It has Ind AS 103, few aspects of business combination. It has Ind AS 36, impairment of assets of goodwill, a new kind of variety of adjustment of goodwill. That concept has been involved. They've also have included and Ind AS 16, property, plant, equipment, decommissioning liability. There was a mistake happened and there is a rectification afterwards. So quite a few adjustments have been part of this problem. So many students have made a request, can you solve this consolidation problem in your working note format? And that is the reason why I have selected this problem. Let us move ahead. Let us read the problem. Ishwar Limited holds investments in Vinayak Limited. The draft balance sheet of the two entities on the 31st March 2004 were as follows. Assets, property and equipment, investments, inventories, trade receivables, then cash and cash equivalents, share capital, retained earnings, other components of equity, provisions, long-term borrowings, deferred tax, trade and other payables, short-term borrowings. Additional information on 1st of April 2001 and this balance sheet is on 31st March 2004. So 3 years back. Important point, 3 years back. They have acquired 400 million shares. This is one more area where institute plays with your feelings because here they have given thousands and all the data are given in millions. So don't get offended, my dear friends. 1 million means, 1 followed by 6 zeros. And the 1000 means 1 followed by 3 zeros. So basically, if I have to convert a million into 1000, I should take out 3 zeros out. So when I say 400 million shares, if I want to take 3 zeros out, remaining 3 zeros will remain. So wherever they will give you million and I want to convert it to 1000, so 400 million, that means 3 zeros out, remaining 3 zeros remaining. So whenever I want to convert million into 1000, I will multiply it by 1000. So 400 million, if I want to make it into 1000, 400 multiplied by 1000. Got the point? So keep this in mind. By means of an exchange of one share in Ishwar Limited for every 2 shares acquired, the market value of one share of Ishwar Limited was rupees 7. Ishwar Limited appointed a professional firm conducting due diligence for acquisition of Vinayak Limited, the cost of which amounted to 15 million. Ishwar Limited included these acquisition costs in the carrying amount of the investment in Vinayak Limited. In the draft balance sheet of Ishwar Limited, there has been no change in the carrying amount of this investment. Ishwar Limited own balance sheet since 1st of April 2001. So this is cost of acquisition. Ind AS 103. This is Ind AS 103. Cost of acquisition is not to be adjusted with the goodwill. Cost of investments should be taken to P&L. And if you look at the investment amount, what is the amount of investments? You look at the asset side, investment amount is 21,15,000. So let me give a breakup of this, what and all happening. So investment, if I give a breakup, amount is 21,15,000. This I will break down into 3 parts or one by one I'll do it. First, cost of acquisition. They said cost of acquisition as per Ind AS 103, it should be taken to P&L. Cost of acquisition, that is Professional valuer, how much they have paid? 15 million, but I want to convert into 1000. So it becomes 15,000. I told you, million into 1000, 3 zeros will come as extra. So 15,000, this will be taken to P&L of which company? This will go to P&L of holding company. They should have taken to their individual P&L account on the date of acquisition and not to be adjusted with the cost of investments. And in our working note format, this will go to Con PL column or consolidate other equity. That column we write, right? The second column, goodwill calculation, other equity calculation, other components of equity calculation, and then NCI calculation. This will go to Con PL calculation under the heading holding company. Then we have investment in subsidiary. Investment in subsidiary. That amount is they have purchased 400 million shares, so I'll make it as 1000. 400,000 multiplied by means of 1 share for every 2 shares. So into 1 by 2, that means they have acquired 200,000 shares and each share is valued at 7 rupees. So multiplied by 7. That's all right. 400 into 1 by 2 into 7. Yes, let me calculate. What do you get? 400,000 divided by 2 into 7. You get 14 lakhs. Now this 14 lakh will be part of investment in subsidiary. So in our working note format, this will be taken to goodwill column. Basically calculation for goodwill, investment in subsidiary, this will be set off. The balance investment is other investments, that is 21 lakh 15,000 minus 15,000 is 21 lakh minus 14 lakh is 7 lakh. The balance investment as 7 lakh will continue to be shown in consolidated balance sheet. Consolidated balance sheet. So this investment, I hope you are clear about it. Let's move further to the next set of adjustments. An individual financial statements, Vinayak Limited showed the following balances: retained earnings 50 million, other components of equity 25 million. So I think if you read further, there are no good bonus adjustment, dividend adjustment. So this I can divide this into pre-acquisition and post-acquisition profits. So let me do this now. Retained earnings, as per balance sheet, it is 10 lakh 50,000. If I'll divide this into opening and current, I'm not opening, I think this is acquired 3 years back, right? So I'll say pre-acquisition and post-acquisition. On the date of acquisition, it was 750. 750 means three zeros extra. That is 7,50,000. So balance 3 lakh is post-acquisition. This requires no further confusion. Other components of equity on the date of balance sheet, I mean on date of acquisition 25 million. On the date of balance sheet, it is 50,000. So 50,000 is pre-acquisition and 50,000 was on the date of acquisition, I mean on the balance sheet date, I'm sorry. 50,000 is the balance sheet amount, 25,000, 25 million. 25,000 is pre-acquisition and 25,000 is post-acquisition. Okay, great. So this is regarding analysis of profits. Let me also compute percentage of acquisition. 400 million acquisition means 400,000, and how many shares are there? 5 lakh means 5 lakh thousands and 1 rupee shares. So what is the percentage of acquisition also? Let me just calculate here. percentage of acquisition 400,000 divided by 5 lakh, 1 rupee face value. So you get 80% for holding company share, NCI 20% share. So this is done. This is done. Retained earning is done. Okay, let's go to further adjustment. The directors of Ishwar Limited carried out a fair value exercise to measure the identifiable assets and liabilities. The following manners emerged. A property having a carrying amount of 800 million had an estimated value of 1000 million, where land component 350, building component 450, revalued at 400 and 600. Buildings of the property had an estimated useful life of 30 years at 1/4/2001. The reason why they have given land and building separately, because land is not subject to depreciation. Only building will be subject to depreciation. So you calculate revaluation profit or loss on the date of acquisition. That adjustment we have to give. And whenever the assets are revalued, that is pre-acquisition profit, the subsequent period there will be depreciation, which is what we have to do. So let me do one by one. I can do land and building together, or I can take it separately. I'll do separately. Land, fair value adjustments. What are the things to be considered? What is the fair value gain? That is nothing but revaluation profit. Revaluation profit is land component 350 and valued at 400. Again, this is rupees, you have to convert it. 400,000 minus 350,000. So basically you get 50,000 as fair value gain. And then whenever there's fair value gain, in this problem actually, sorry for skipping the point, the rate of deferred tax to apply temporary difference 20%. That is why Ind AS 21 also is there. It's a super duper problem. You have consolidation, you have business combination, you have deferred tax, you have impairment, you have plant property equipment. Amazing complex cocktail problem. That is why important from exam point of view. So deferred tax also will be there. So 50,000. Yeah. So 50,000 revaluation profit, and on land depreciation will not come. But on fair value gain, you will have a deferred tax liability. 50,000 into 20%. That is 10,000. So 50,000 will come in two places. One, it is a pre-acquisition profit. So pre-acquisition profits means, it will come in goodwill calculation, as well as it will come in, what do you call, NCI calculation. And also it is going to affect the balance sheet asset side. I mean, in the consolidated balance sheet. On the asset side, when I take the land of holding, land of subsidiary, I have to adjust the fair value gain as well. Similarly, deferred tax liability. Maybe I should calculate like this. Just give me 1 second. Because the fair value gain and depreciation gain impact. So just give me one thing. Let me just show like this. Land fair value treatment and then depreciation treatment. Of course, on land, no depreciation, but I'm just showing it as a reference. Fair value, you will get it as I just showed you now, right? 350 and 400. So 350 and 400, 400 minus 350. So 50,000 because I'm converting from million to thousands. And on fair value, you have to consider deferred tax impact and net. So deferred tax liability will go to 20%. So 20%, 50,000, 20%, that is 10,000. Net, that is 40,000. And this I can show 50,000 separately, 40,000 separately, but net 40,000 is what I will take it in the working note for goodwill calculation, pre-acquisition profit. 10,000 of course will go to consolidated balance sheet. Of course, we are also going to affect this 40,000 when we do the asset adjustment. That is anyway going to be there. But keep it in mind, these calculations. Similarly, I'll come to building, where I'm going to do fair value calculation and depreciation calculation. What is a fair value adjustment building? Components 450 valued at 600. So 600 minus 450 means 150. Convert from million to thousand. 150,000. Calculate deferred tax liability 20%, and therefore that comes to 30,000, and that will go to consolidated balance sheet. And net 1 lakh 50 minus 1 lakh 30,000, 1 lakh 50 minus 30, 1 lakh 20,000, that we will take it as pre-acquisition profits for goodwill calculation and NCI calculation. And whenever there is a revaluation profit or loss, there will be a depreciation. And depreciation, please keep it in mind, it is on the amount of revaluation, depreciation or revaluation, and it is to be spread across useful life. Useful life is 30 years and 3 years completed. I told you 3 years completed. So again, depreciation also, what we have to calculate is what is the depreciation impact, and then the deferred tax liability impact also should be considered correspondingly, right? So on 1,50,000, useful life 30 years, 3 years completed. So 1,50,000 into 3 by 30. Well, 15,000. This is depreciation. On this you calculate what is the DTL reversal. The 20% on 15,000 is 3,000, and net comes to 12,000. This 12,000 net is post acquisition profit, and this 3,000 deferred tax liability will be considered in the balance sheet. This is the deferred liability 3,000 will be considered in consolidated balance sheet. That deferred tax liability, whatever we take it here, right? So we create a deferred tax liability of 12,000, that will be reversed to the extent of 3,000. And this 15 minus 12 post acquisition profit depreciation we will consider. Similarly, I will do for plant and machinery. I hope this you can also try. I'll do a little fast. Plant and machinery having carrying amount of 600, fair value at 700. So plant and machinery, two parts, fair value, then depreciation impact. Fair value 700 minus 600, that is 100,000. This we will divide this into two parts. One is deferred tax liability 20%, so 20,000. Net, that is 80,000. And deferred tax liability, you know, I will take to consolidated balance sheet. Net 80,000 is for pre-acquisition profits calculation. Depreciation, this has a useful life of 4 years. So 1 lakh divided by 4, 25,000, same to impact, What is deferred tax liability reversal? 25,000, 20%, 5,000. This will go to consolidated balance sheet. Then balance 25 minus 5 net 20,000. Wait. 3 years complete, right? I'm sorry. Into 3. 3 years completed. Sorry, that I forgot. Yes. Sorry. 3 years completed. So 1 lakh divided by 4 into 3, you get 75,000. 75,000, 20% is 15,000. 75 minus 15 means 60,000. 60,000 will be treated as post acquisition profits. Basically, that will be taken in the calculation of CONPL and NCI. So this is the treatment of what will happen to an asset when revalued when there is deferred tax impact, which we usually used to ignore in other problems while we doing in our classes. Okay, so land and building is done, plant and machinery is done. Contingent liability, on 1st of April, notes to accounts of our statement disclose contingent liability. The fair value of this contingent liability was reliably measured at 30 million. The contingency was resolved in the year ended 31st March 2002 and no payment was required in respect of contingent liability. Contingent liability is normally disclosed in notes to accounts, but as per Ind AS 103, it is recognized as part of net assets taken over, and therefore we should take it very similar to a revaluation adjustment in our working note format, a very similar to revaluation adjustment, and it's a loss contingent liability. And subsequently, when contingent liability resolved, no need to make any payment. That will be transferred back to consolidated P&L account, and corresponding deferred tax impact we should consider. So let's do that. So contingent liability is similar to, you can take it like, just for understanding purpose, it is similar to revaluation loss. Why I'm telling revaluation loss? On the date of revaluation, it is a pre-acquisition, and subsequently it will become post-acquisition for depreciation. Revaluation is minus, depreciation is plus. Correct? A same concept applies. Contingent liability, you recognize that will be a loss, a pre-acquisition element loss, and subsequently when it is resolved, it will be returned back to CONPL. That becomes a profit, that becomes post-acquisition element. Okay, so amount of contingent liability was 30 million. So 30 into 1000, 30,000. So 30,000 to impact. This is you are going to treat it like a revaluation loss. So it is pre-acquisition profits. Or you have to consider deferred tax impact. DTA, because it's a loss, means you get deferred tax asset 20%. 20% of 330,000 is 6,000. Net 24,000 will come in pre-acquisition element as a minus number. Then reversal of contingent liability, just like fair value and depreciation there, reversal of contingent liability, that is because next year it is reversal, DTA reversal, same 30,000, 20% means 6,000, and what goes to CONPL as an addition is balance net 24,000. So basically net amount I can treat DTA once created, once reversed. This has no impact. You can ignore it. So 24,000 pre-acquisition contingent will come as a pre-acquisition loss, and CONPL 24,000 will come. Of course, it is distributed between CONPL and NCI. It is CONPL and NCI. This is a post-acquisition element. You can treat it as a post-acquisition element. You're writing it back to the holding company P&L. subsidiary company P&L. When you would write it back to subsidiary company P&L, it will be distributed to the owners, which is holding and NCI. Okay, so contingent liability and depreciation is done. Investment adjustment is also done. Okay, let's read further. The fair value adjustment, then rate of deferred tax I told you. Impairment of goodwill. Impairment of goodwill was evident when they carried out on 31st of March. No impairment. 31st March 2004, Directors of Issuer Limited carried out a further review and concluded recoverable amount of net assets was 2000. So this requires to compute our goodwill, then take the net assets of subsidiary company and then compare any impairment. And because in this problem they have gone on proportionate basis, uh, the directors are using proportionate net assets basis, not fair value basis. So when goodwill is repairing, it should also be in proportionate basis, and entire goodwill should go to ConPL and not go to NCI. So the impairment part, once I calculate, I'll give the treatment again. As of now, we can ignore this adjustment. Provision on 1st of April, Issuer Limited completed the construction of non-current assets. Okay, this is Issuer Limited, holding company, nothing to do with subsidiary company. A non-current asset with a useful life of 20 years, 1/4/2003, meaning beginning of this year. The cost of construction was recognized in the property, plant, equipment and depreciated appropriately. Issuer Limited had a legal obligation to restore the site on non-current asset which is located in 31st March, which is located on 31st of March 2043, 30 years later. Obligation to restore the asset to original condition, Ind AS 16. Provision for dismantling, provision for decommissioning. The future liability should be recorded today at present value basis. Estimated cost of restoration of this work is 125 million, but I need present value. What directors have done? You are going to spend 125 million. Directors of Issuer Limited have made a provision of 6.25 in the balance sheet of 31st March 2004, which is a wrong provision. You can't say provision divided by 20 years or divided by 30 years. You can't allocate like that. That is a wrong thing. An appropriate annual discounting rate 6% at the rate of 1, payable in 20 years at 31.2 paisa, prepare consolidation balance sheet. Okay, so this is requiring a rectification in the books of holding company. Let me show that calculation. Provision for decommissioning, existing treatment, and then correct treatment. Existing treatment, they have taken provision of 6.25, created a provision of 6.25. This to be reversed. And what will happen when you reverse it? The provision will reduce. Say provision account debit to P&L. Originally when you created P&L account debit to provision, it is in the books of holding company, not in the books of subsidiary company, not affect our working note format. This is not the subsidiary company transaction, only holding company. So we affect only holding company books of accounts. So provision will provision will reduce by 6.25 million. Why 6.25 million? Please go to balance sheet. You can verify that. You see provision 6,250, 6.25, 6.25, 6,250. When you made a provision, the journal entry was P&L account debit to provision, P&L to provision. It's a wrong calculation. Reverse the effect. Provision to P&L. Provision account will be closed. Provision will reduce by 6.25 and P&L Holding company P&L will increase by 6.25. Holding company provision will increase by 6.25. And the correct treatment is, as on the opening balance sheet, you should recognize an asset as well as a liability. You should recognize an asset as well as a liability. Basically, value will be capitalized to the extent of present value. Amount of obligation is 125 million multiplied by 31.2 paise. 125 million into 31.2 paise means 0.312, and expressed in thousands multiplied by thousands. So 125 into 0.312 into thousands, you get 39,000. 39,000 you should recognize as an asset and recognize as liability. And then you provide depreciation on assets over the useful life. The useful life of the asset is how many years? 20 years. So this 30,000 is depreciated over 20 years. 39,000 divided by 20. 1950. I'm assuming this is allowed for income tax purpose. Otherwise, on this also you will have a deferred tax impact. Then net. This depreciation will go to holding company P&L, and the holding company P&L means our con-PL column. Then net, that is 39,000 minus 1950, 37,050. This will go to balance sheet. On the asset side, that will increase whatever the non-current assets, it will increase by 37,050. Yeah, liability wise, you create a provision, and provision will be undiscounted, meaning you will charge a corresponding interest to P&L. So interest on 39,000 at the rate of you are providing at the rate of this is 6%. So 39,000 into 6%, 2340 interest, and net provision, don't subtract. This interest will go to holding company P&L as expense. 39,000 minus 2340, 36,660 will go to consolidated balance sheet as provision. Not 30, should add, not subtract. I'm sorry. I just told 39,000 plus 2340, 41,340. Yeah, 41,340 will go to balance sheet as the net provision after adding the interest. Unwinding of discount. Unwinding of discount is what they call it. Okay, so these are the working notes. Now we can prepare our regular working note format, and then we can go for consolidated balance sheet. So our working note statement for consolidation. We will start with like particulars. I hope you know the format. Amount. This amount column is also important now, because for impairment purpose we need the net assets of subsidiary. So the amount I'm writing here, I'll use it as a net assets of subsidiary on the date of acquisition, on the date of consolidation. So goodwill calculation, con-PL, or basically this is other components of equity. You can also say other components of equity. I'll just say con-PL, and then NCI. Okay, I'll start with subsidiary company first. And for reference, holding company percentage, which I showed you earlier calculation, 80%. NCI 20%. I'll start with share capital. If I remember correctly, I think it is 5 lakh. So 80% means I get 4 lakh and 20% is 1 lakh. Then retained earnings, and then we have other components of equity. Retained earnings, we have pre and we have post. Pre-acquisition, if I calculate, if I remember correctly, I think 7,50,000. Yeah, 7,50,000, 3 lakh, then 25,000, 25,000. So 7,50,000 and 3 lakh. So 7,50,000, 80%, that is 6 lakh. And 20% is 1,50,000. 3 lakh is post acquisition, so I will take it in ConPL 2,40,000 and 60,000. Then we have other components of equity. Again, pre and post, I think both were 25,000 each. Pre 25,000, 20%, that is 80% is 20,000 and 5,000. And similarly, post acquisition 20,000 and 5,000. So that is done. Then coming to fair value adjustments, fair value gain. We have this fair value land, fair value building, fair value plant machinery, net basis. Either you can do one by one or I can do total. I think I can do total, right? 40,000, 1,20,000, and plant and machinery net 80,000. So 2,40,000. I think I can do directly, right? Fair value adjustment. I hope you can understand. 2,40,000. I am writing on net basis. Fair value adjustment of all the three things together. Fair value adjustment 2,40,000. Pre-acquisition profit 80%, 1,92,000. 20%, 48,000. Then depreciation adjustment on land will not come. Depreciation on building is 12,000. Depreciation on machinery is 60,000. 12,000, 60,000 net. I can do 72,000 sum also. I'll do net amount. Hope you understand. Depreciation on above. And remember, this is post acquisition. I'm adding those two amounts, 60 and 12. And this will be minus 72,000. So I'll write within brackets. 80% of that is 57,600 is post acquisition. So I'll take it in ConPL and NCI 14,400 within brackets. Land anyway, no depreciation will come. Then what else adjustment will come? Land done, building done, plant and machinery, contingent liability. Contingent liability creation of this one and then reversal. 24,000, 24,000. Creation is pre, reversal is post. So contingent liability creation is pre, then reversal is post, and I am doing on net basis after the adjustment of deferred tax. 24,000. So 24,000 creation, 24,000 reversal. So this is like a loss, then a profit. So 24,000 within brackets, you get 19,200 and then 4,800, and same thing when you reverse, you take it to ConPL 19,200 NCI 4,800. And you can do sum of this for your internal reference. The sum of all these amounts will give you the subsidiary company net assets will be relevant for impairment calculation. So 5 lakh plus 7 lakh 50 plus 3 lakh plus 25 plus 25 plus 2 lakh 40 minus 72 minus 24 plus 24. 17 lakh 68,000. This is net assets of subsidiary on date of consolidation. This is relevant for my impairment calculation. Okay, I think subsidiary company heading is done. Now I'll come to holding company heading. Again, keep it in mind, under these three columns only I should take it. First I'll start with investments in subsidiary. Which I showed you the calculation at the beginning. That is cost of investment, I'll go to P&L. Investment in subsidiary 14 lakh. Yeah, that 14 lakh will take it here. Investment in subsidiary 14 lakh. This is for entire amount of 14 lakh will go to goodwill calculation. Then holding company's retained earnings. Holding companies con PL. Holding companies retained earnings 28 lakh, no, sorry, not con PL, other components of equity. Other components of equity, retained earnings 28 lakh 65,000. Entirely will go to con PL. Then other components of equity, which is 12 lakh 50,000, will go to 12 lakh 50,000 con PL. Okay, then we have to do some adjustments. What are those adjustments? We'll have to provide for the cost of acquisition, right? Cost of acquisition, they have taken to investment, holding company. First adjustment we discussed, 15,000 negative. That I will subtract entirely in con PL. Okay, so this cost of acquisition 15,000 goes to P&L. Then we had some adjustments with respect to decommissioning liability, provision reversed, then interest taken to P&L, depreciation on that taken to P&L, that will be taken to con PL. Provision reversed, then interest on above, interest on the provision, that is unwinding of discount, then depreciation on decommissioning part of it, the asset part of it. So provision reversed, I think 6250 if I remember correctly. Interest on provision, what and all amounts. So P&L 6.25, so 6,250 is reversed. Provision anyway will reduce and provision will increase 6.25, and then interest 2340 will go to P&L, and asset depreciation 1950. So 2340 1950. 2340 1950. So 6,250 is added, 2340 is subtracted, 1950 is subtracted. Okay, so the balance what you get now is the goodwill just before impairment. This amounts what you get is before impairment, because they said some impairment of asset also taking place. So let me calculate the goodwill. 4 lakh plus 6 lakh plus 20,000 plus 1,92,000 minus 19,200 minus 14 lakh. I think you get 2,07,200 within brackets. Now this is what is subject to impairment. Coming to con PL before impairment, 2,40,000 20 minus 57,600 plus 19,200 my plus 28 lakh 65 plus 12 lakh 50 minus 15,000 plus 6250 minus 2340 minus 1950. Something is wrong. Let me calculate once more. 2,40,000 plus 20 minus 57,600 plus 19,200 plus 28,65,000 plus 12,50,000 minus 15,000 plus 6250 minus 2340 minus 1950. I think 43,23,560. 43,23,560. Yes, subject to impairment calculation. Then NCI calculation, 1 lakh plus 1,50,000 plus 60 plus 5 plus 5 plus 48 minus 14,400 minus 4,800 plus 4,800. So 3,53,600. This will not change because the impairment of loss is only relating to holding companies, a proportionate method. That's why. Anyway, so 3,53,600. This is before impairment. Let me do impairment calculation. Impairment of goodwill. Okay, now impairment of goodwill calculation. Impairment normal format, we compare the recoverable amount with the carrying amount. The difference is called as impairment, and the first we attribute towards goodwill. But in this case, goodwill is method recognized on proportionate method. So the recoverable amount is entire subsidiary company amount, whereas goodwill is only relating to holding company share. So artificially we have to create, that's called as grossing up of goodwill. So format we go like this. Impairment is difference between the carrying amount minus the recoverable amount. That you know it, right? So one column will have for net assets, one column will for goodwill, but in this problem, because goodwill is only related to holding company share, I will also do grossing up, or I will call like this: goodwill relating to holding company share and then goodwill related to NCI share. And then I will do the total. Now net assets, how much we got? Net assets is 17,68,000. Goodwill relating to holding company share, we got 2,07,200. Now I cannot do only sum of these two because goodwill is only related to holding company. What institute does, they say this is holding company share, how much to be total. What I'll do calculation, 2,07,200 is 80%. How much for NCI share? 20%. So 2,07,200 divided by 80, how much for 20? 51,800. So this, when I get it, I will know the amount of goodwill, or I can do total. So 2,07,200 plus 51,800, 2,07,200, 2,59 is the total goodwill of subsidiary. But anyway, 17,68,000 plus 207,200 plus 51,800. Remember, this is notional. This is not actual recognized. 27,000. And what is the recoverable amount? The recoverable amount is 2,000 million. That means 2,000 followed by the three zeros. That is basically 20 lakh. So what you get is 27,000 is the impairment. Now this 27,000 impairment first as allocated to goodwill. Again, when I created goodwill, I took both holding company and NCI share. So when I am allocating goodwill, I should distribute to both. 27,000, 80% goes to holding company share, 20% goes to NCI share. So 27,000 into 20%, 5,400, and balance, that is 80%, 21,600. So 21,600, only this impairment recognized. 5,400 impairment of goodwill not recognized, because goodwill relating to NCI share only not recognized. This 51,800 not recognized. Method of goodwill on proportionate basis. So 5,400 impairment of that also is not recognized. Had the goodwill been recognized on fair value basis, then the goodwill would have been 2,07,200 plus 51,800. So this 5,400 also impairment would have been taken to Con PL account. Hope you get the concept. Anyway, so impairment 21,600, and straight away I simply take it to Con PL column. So this before impairment, then impairment 21,600, I subtract in Con PL and I add in goodwill. Basically means in my method, goodwill will be reduced when I show a positive number. So this is minus, this is plus. So this will be the net amount. I will take it to balance sheet. 207,200 minus 21,600. So 1,85,600. And this is 43,23,560 minus 21,600. 43,01,960. 43,01,960, and then NCI no change, 3,53,600. If goodwill was recognized on fair value basis, this impairment would have been allocated to Con PL and NCI on proportionate basis, if the goodwill was recognized on fair value basis. Okay, so these are the working notes that is relevant. Maybe we'll prepare one working note on assets, because land and building is there, fair value adjustment is there. All other things we can straight away take it in the balance sheet. So let me go to the asset side. We have PPE. Oh, everything is there here. Okay, fine. So we have holding, we have subsidiary, holding, subsidiary, then some adjustments of revaluation profit and depreciation on it. Then we get net basis. So PPE as given in the problem, 26,20,000, 18,50,000, 26,20,000, 18,50,000, 18 lakh 50, 18 lakh 50, 18 lakh 50, 18 lakh 20, 18 lakh 50, 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 Revaluation, you have land, then you have building, then we have plant and machinery. We have done the working notes, right? I can take use of. While doing these numbers, don't take deferred tax. Only gross amount you should take. So land 50,000 and no depreciation. Land 50,000 and no depreciation. Then building fair value 1,50,000, depreciation 15,000. No deferred tax adjustment. So 1,50,000 and 15,000. Then plant and machinery 1,75,000. 1,75,000. Okay. A holding company has one more thing, decommissioning liability adjustment, right? So decommissioning liability adjustment. So recognition, then depreciation. Initial recognition and then provide depreciation. And no need to do any reverse of provision here. The provision created was only taken to P&L by the company earlier, which we reverse in P&L provision. Asset will not be affected. So recognition that we created here before working note, assets, net only I have calculated, no, already 39,000 asset, depreciation 1950, 37,050, net only I have 37,050. Yeah, net only I can take it. 37,050. Okay, so add all these numbers. So what do you get? 26 lakh 20,000, 18 lakh 50,000, plus 50,000, plus 1 lakh 50, plus 1 lakh, minus 15, minus 75, plus 37,050. So 47 lakh 17,050. $47 lakh 17,050. Okay, I think now you're ready for preparation of consolidated balance sheet. I will do it quickly. Coming to the asset side, we have non-current assets, PPE, for which you have done the working note just now, 47 lakh 17,000 something. Then intangibles, that is goodwill, again we have done the working note, 1,85,000. Then investments, I showed you at the beginning itself. See, balance sheet 7 lakh will come. The other investments, outside investment in subsidiaries, outside the group, 7 lakh. Current assets and all, no adjustments as such. So we can simply do inventory 6 lakh plus 3 lakh 75. Inventories 9 lakh 75. Trade receivables 4 lakh 50, 3 lakh 30, that is 7 lakh 80. Trade receivables 7 lakh 80. Cash and cash equivalents 75, 60, 1 lakh 35,000. Total, I hope the balance sheet is 74,92,650. Okay, that is on the asset side. Now let me do on the liability side, equity and liabilities. First, equity. We have share capital, other equity, and non-controlling interest. Share capital, only holding company, which is 7 lakh. Other equity, we have done the working notes, 43 lakh 1,960. And NCF, we have done the working note, 3 lakh 53,600. Coming to non-current liabilities, we have some debentures. So let me say long-term borrowings. Which is long-term borrowings, 4 lakh 13 plus 4 lakh 50, 8 lakh 63,750. 8 lakh 63,750. Then provisions also, long-term provisions. We have done the calculation, 6250 minus 6250. Then I show the calculation that decommissioning liability. Where is that decommissioning liability correct treatment? Liability 39,000 plus 2340, 41,340. Existing, don't worry, 6250. Anyway, 6250 will reduce, that will become 0. So new provision 39,000 plus 2340, you get 41,340. 41,340. Then deferred tax. Okay. Coming to deferred tax, what we have in balance sheet, maybe I'll do a small note because quite a few things were there. So I'll just do a note on deferred tax calculation here. Note on deferred tax. Okay. So holding, subsidiary, deferred tax liability. From the holding company, we have 2 lakh 25 and 1 lakh 40. 2 lakh 25 and 1 lakh 40. Then adjustments. What adjustments? We have created deferred tax on, you see, on fair value of land, fair value of building, and fair value of plant and machinery. So fair value of land, fair value of plant and machinery on fair value of building. Let me do building. Then fair value of plant and machinery. Then deferred tax reversal also took place because of depreciation. So depreciation on building and depreciation on plant and machinery. Maybe you can also show contingent liability on creation. Deferred tax asset was there, then reversal, contingent liability closed. But because created and closed, net effect will not be there. I ignore it. Otherwise, you should keep that also in mind. So on fair value and all, what was the amount? We had calculated at the beginning. Deferred tax liability 10,000, 30,000, then 20,000, right? 10, 30, 20. So 10,000, 30,000, 20,000. This is created, reversed. That is because of depreciation you minus. So depreciation, because of that, reversal also I showed you. You get 3,000 reversal here and here you get reversal of 15,000, 3 and 15,000. 3,000 and 15,000. Okay, so net basis 2,25,000, 1,40,000 plus 10 plus 30 plus 20 minus 3 minus 15, you get 4,07,000. So deferred tax liability 4,07,000. Current liability and no adjustment. Trade payable, short term borrowings, no adjustment there. Trade payables and short term borrowings. Trade payables 3 lakh plus 2 lakh 50, 4 lakh 50,000. Sorry, 5 lakh 50,000. Then short term borrowings 1 lakh and 1 lakh 75, 2 lakh 75,000. And you can do the total. Hopefully this side also tallied. 7 lakh, 43 lakh 1,960 plus 3 lakh 53 600, 8 lakh 63 750, 41 340, 4 lakh 7,000, 5 lakh 50 and 2 lakh 75. So 74 92 650. Yes, 74 92 650. And Institute also have done the same calculations, but they have shown differently. But since people wanted in my format, I have done. But good problem, quite a few adjustments, and I hope you made the best use of it. I just want to show the Institute solution here. So I'm just scrolling down. Where is 3/4 question? Yeah. So you see 47 17 50, yes, 1 lakh 85, and then 7 lakh investments intangible 1 lakh 85, 9 lakh 75, 7 lakh 80, 1 lakh 35. Coming to liability side, 7 lakh 4301 960. They have given separately, but total is 4301. Then NCA 3 lakh 53, NCA 3 lakh 53 600. Provision 41 340, provision 41 340, deferred tax 4 lakh 7, deferred tax 4 lakh 7. So all the amounts are matching. So I hope this video was useful. RTP number 23 exam question, a super duper problem covering consolidation, business combination, impairment of assets, deferred tax, and property, plant and equipment. All adjustments may not come in exam, but if you have done this problem, even if part of the problem comes in exam, you'll be in a much better position to face it. Don't be surprised if same question also may come in the examination. I hope this video was useful. See you next time. Take care. Bye-bye.